Basic rules and records in accounting. At any point in time, the resources of a business entity should equal the claims of persons who have financed these resources. At any given point in time for a business, the resources of a business unit are provided by its proprietors and outsiders, where the claims of the proprietors are known as capital, while the claims of the outsiders are known as liabilities. In other words, the total assets of a business entity are equal to its capital and its liabilities, which is represented by the equation also known as accounting equation approach, which says assets is equal to capital plus liabilities. Transactions are written in vouchers, which is a documentary evidence in support of a transaction. Examples are a cash memo showing cash sale, an invoice showing sale of goods on credit, etc. This must be preserved until such time that the audit of the account or tax assessments are complete for the concerned period. On account of this, one writes which accounts are debited and which accounts are credited, which is done in a journal. A debit denotes, in the case of a person, when he becomes liable to do something in favor of the firm, his account is debited. In the case of goods or properties, it indicates stock of value of goods and properties increased, and in case of other accounts, the firm has lost money for paying salary or rent. A credit, on the other hand, denotes, in the case of person, he or she claiming a return from the firm for benefits received from him or her. In case of goods or services, the stock and value of goods diminished, or in case of other accounts, the firm has made a gain in terms of commissions, etc. The cash book, on the other hand, records all cash transactions on left hand side. It records receipts of cash, and on the right hand side it records payments of cash. In modern business, transactions through banks are also in plenty, which is also incorporated in cash book. Hence, in cash book there are two columns on each side of the cash book, one to record cash transactions and one to record bank transactions. That is, payments to bank are entered on the left hand side and payments out of the bank are entered on the right hand side. Next is purchases book and sales book. All credit purchases and credit sales are recorded in the purchases and sales book, since cash purchases and cash sales are recorded in the cash book. Next is returns book. Goods returned to suppliers return outwards, since materials or raw materials are to be returned, and goods returned from customers, which is returns inward, or goods sold are returned to firm, are recorded in the returns book. So primarily returns book is returns outward for materials from suppliers and returns inward for goods which are bought by the customer and returned to the firm. Next, we take a look at journal. When a business starts books for a new year, it has to make opening entry in the journal, which is the opening balance of various accounts that are to be transferred from the previous year's books to the new year's books. The opening entry is made in the journal and the closing entries are made at the end of the trading period to close books. Hence, cash book, purchases book, sales book and returns book, which merely facilitates the preparation of accounts of the ledger, are called subsidiary books or books of original entry. On the other hand, the books that contain account is known as ledger. Since the final assessment of financial position of a business emerges from these accounts, the ledger is also known as principal book. Examples are furniture account, computer account, etc. There are also rules for posting to the ledger accounts from subsidiary books, as for instance, first, the opening entries are posted, then cash book is posted, then purchases, sales and return books are posted, and finally the journal is posted. Posting other entries from journal involves or shows which accounts are to be debited and which accounts are to be credited. Suppose in journal, furniture account and computer account are debited with a total amount of, let's say, rupees X, and XYZ Limited is credited with the same amount. In ledger, the furniture account and computer account will be debited and the account of XYZ will be credited by rupees X. After posting is complete, the accounts are balanced. For balancing, if we find out the difference in totals of two sides are ascertained, and if the debit side is bigger than the credit side, the difference is debit balance, and if credit side is bigger than the debit side, the difference is credit balance. The accounts to be balanced are those accounts of persons and properties. Afterwards, capital account is balanced. None of the other accounts are balanced since they will be taken to consider for profit and loss account. So also the accounts are of different types, namely personal account, which are accounts of persons, creditors or customers, real account, which are properties and assets, and nominal account, which are income, expenses and losses. There are also rules for debiting and crediting the different types of accounts in ledger. Now there are certain rules which needs to be followed in the case of personal, nominal and real accounts. For personal accounts, debit the receiver, credit the giver. That is the rule followed. For nominal accounts, the fundamental rule is to debit all expenses and credit income and gains. For real accounts, debit what may come in and credit what goes out. Hence, all transactions are recorded in the journal and are posted to ledger accounts. The process of recording transactions in the journal is called journalizing, and the process of recording transactions in the ledger is called as posting. It also should be kept in mind that for every amount that is placed on the debit side of an account, which is ledger, there is a corresponding entry on the credit side of some other account, and this is in fact according to the principle of double entry system. Hence, it is sensible to understand that the debit balance of all the accounts should match or agree with the credit balance of all the accounts. Business periodically arranges this statement separately in a statement to see if the debit balances match with the credit balances, and such a statement is called as trial balance. There are two methods of creating a trial balance, namely totals method, where the totals in debit and credit balances of ledger accounts, excluding closing balances, are shown in trial balance, as opposed to balances method, where only closing balance of the ledger account is only shown in trial balance.